Hi everyone. After I shared more about CapitaLand Ascendas REIT in my previous YouTube video, there's been quite a lot of discussion around the acquisition of one of the data center assets in the Singapore market. So thanks so much for sharing your comments. At the same time, we also saw news relating to one of the key data center REITs in the Singapore market, Keppel DC REIT, over the past week. It was included in the benchmark Straits Times Index in Singapore. So what I wanted to do in today's video is really walk us through some of the fundamentals of Keppel DC REIT and understand how the inclusion into the Straits Times Index will potentially impact the REIT. Just some disclaimers before we start. Today's sharing about Keppel DC REIT, as well as some of the other REITs that are mentioned, is not actually financial advice that is catered to your individual investment objectives as well as risk appetite. So do speak to a financial advisor before you decide whether to buy or sell these securities that are mentioned. We actually did a poll in our Beansprout Telegram community. So this is to understand what are some of the stocks, REITs, as well as funds that our community is actually interested in. And quite interesting in that of the more than 200 votes that were submitted, a significant number actually chose Keppel DC REIT as something that you would like us to share more about. So I think that is really the purpose of today's video, to be able to discuss how we see Keppel DC REIT. Okay, so if you want to actually take part in our future polls, do subscribe to our Telegram group. At the same time, do subscribe to our YouTube channel so that you can be updated when we share more about these REITs and stocks and funds that you are interested in the future. Okay, so this was the news that I saw last week, came out on the 5th of June. There is a change in the Straits Times Index as part of the June quarterly review. Okay, so what I see here is that there is one company that is entering the STI and one company that is exiting the STI. So the company that is entering the STI is Keppel DC REIT, and the company that is exiting the STI is 𝗕𝗲𝗰𝗀𝗀𝗃𝗃𝗃𝗃. I think for many of us might be wondering, how does this actually matter, or even what is the Straits Times Index about? So before I go more into Keppel DC REIT, I will just do a quick introduction about the Straits Times Index so that we can all understand why does this actually matter. The Straits Times Index, or commonly known as the STI, is the benchmark index for the Singapore stocks. It actually dates back to 1966, so it's a very long track record, which is why some of you who have been following the Singapore market will be familiar with it. So what is most important about this Straits Times Index is that it tracks the performance of the top 30 largest as well as most liquid companies that are listed on the Singapore Exchange. Okay, so what this means is that it represents 30 of the biggest companies, and also these companies need to have a certain amount of trading volume such that they are companies that investors are actually interested in. What is also important here is that there are only 30 companies that can be in the Straits Times Index at any point in time. So what this means is that when one company's exit, there will be another company that will exit the Straits Times Index. So this makes it very exclusive in a certain way, because only 30 of the largest and most highly traded companies can be in the Straits Times Index. So what are some of these companies in the Straits Times Index? I have actually put up a list of the top 10 companies in the Straits Times Index. And this is what we see. So DBS Group, a name that we are all very familiar with, is the stock with the highest representation in the Straits Times Index, representing 24.7%, or about 1/4 of the entire Straits Times Index. Next, we have got the two banks, OCBC as well as UOB. OCBC representing about 15.7% of the STI, and UOB representing about 11.8% of the STI. So what we see here is the banks make up the bulk of the STI. And in fact, with this, we see that combined together, the banks actually represent close to half of the representation of the Straits Times Index. Next, we've got some big cap companies that many of you might be familiar with, such as Singtel, representing about 7.9% of the Straits Times Index, ST Engineering, about 3.3%. And next, we have a REIT, CapitaLand Integrated Commercial Trust, the largest REIT in the Singapore market, representing 3.2% of the STI. Okay, so this list actually goes on. We have got SGX, Jardine Matheson, Singapore Airlines, and Keppel. So this would give us a representation around which companies would make up the STI. So what this news actually means is that Keppel DC REIT would actually join this list of 30 companies, which would make up the benchmark Straits Times Index. Okay, so you might be wondering, why does this actually matter? Okay, why do people actually track the Straits Times Index? Why is this something that is noteworthy? Okay, so first and foremost, the Straits Times Index is an index that is tracked by different funds. So for example, we have got exchange traded funds that actually track the STI in a passive way. I'll talk more about the ETFs later, but what this means is that when investors buy into this exchange traded fund, because it tracks the index, so as a result, investors who are buying into the ETF would then also be buying into a share of this underlying constituents in the STI. Okay, so usually this is seen as a sign that there can potentially be more buying into Keppel DC REIT, as some of these managers would then have to buy Keppel DC REIT to be able to track the index. Apart from that, we also have some of the actively managed funds who are benchmarked against the STI. Okay, so this can be potentially mutual funds or other kinds of funds that are tracking the Straits Times Index and having the Straits Times Index as their benchmark. For some of these active fund managers, because they may not actually want to be having their holdings differ too much from the benchmark, what this means is that they may potentially then increase their holdings of Keppel DC REIT as well. Okay, so that is something that we will keep a lookout for as to whether we see more buying into Keppel DC REIT as a result of the inclusion. So this is the share price that I see for Keppel DC REIT. Current share price of $2.26, which is higher than where it was 1 year ago when it was at about 180. So from here, we can see that Keppel DC REIT share price has actually done fairly well. And this is actually in contrast to the REIT sector, which continues to face headwinds. So if you've been following our videos, what we previously shared is that the REIT sector continues to face an uncertain outlook because the interest rates remain at a fairly elevated levels. And at the same time, different REIT subsectors, whether is it office or hospitality, are facing a mixed outlook. So this is something that has impacted the performance of the REITs. But for Keppel DC REIT, the share price has been supported by its ability to grow its distributions, as well as some of the acquisitions that the REIT has been able to make. For those of you who are not familiar with Keppel DC REIT, I will start by giving an introduction about the REIT. Okay, so it is a pure play data center REIT. What this means is that in terms of its assets, it would own 100% of data centers. So all REITs have different exposure to different asset classes. Some may hold retail mall, some may hold offices, some may own hotels. But for Keppel DC REIT, as the name suggests, the assets that it would own would be data center. So when it IPO back in 2014, the assets under management was just at about 1 billion. Since then, it has grown its assets under management to now about 5 billion as of December 2024. Okay, so this 5 billion consists of 25 assets, which are across Asia Pacific and Europe. And this effectively would demonstrate some of the assets that it's been able to acquire over the past 10 years. What is also fairly remarkable would be the total return since its listing, which is at about 240%. And I think that is partly driven by the acquisitions that the REIT has been able to make. Okay, so here I dive deeper into the assets under management. So earlier I mentioned that the total assets under management would be 5 billion as of December 2024. In terms of where these assets are actually in, we see here that Asia Pacific would actually be the bulk of its portfolio. In particular, Singapore assets would represent 65% of its portfolio. So this is fairly different from what we see for another data center REIT in the Singapore market, which is Digital Core REIT, which has the bulk of its assets in US as well as in Europe. Okay, so Asia Pacific will represent 80% of its portfolio. Singapore would be 65% of its portfolio, and it has got some assets in Australia, China, and Japan as well. The remaining assets would be in Europe, which will make up about 19% of its portfolio, and this will be data center assets in Germany, Ireland, Italy, the Netherlands, as well as in the UK. So for many REIT holders, I think one of the key things that matter would be the distribution per unit. So what I did is to go back to the 2024 earnings to understand whether Keppel DC REIT has been able to grow its distribution per unit. Okay, so what I see here is that the adjusted distribution per unit is at 9.504 cents, which is a 1.3% increase compared to FY 2023. Okay, so what I did notice is that for 2024, there were not a lot of REITs that were able to grow their distribution per unit. So the good thing about Keppel DC REIT is that it is one of the few REITs that managed to grow its distributions despite the higher finance cost. In terms of the fundamentals of the REIT, what I see here is that the REIT has been able to grow its gross revenue by 10.3%. It has been able to grow its net property income. And even though the finance cost actually went up, this was something that the REIT manager has been able to overcome with the higher net property income, such that the overall distributable income was still up by 3%. Okay, so while many REITs face higher finance costs back in 2024, because Keppel DC REIT has still been able to grow its net property income, that is why we see that the distribution per unit is still growing compared to 2023. I also went to take a look at Keppel DC REIT's first quarter 25 distribution per unit. So what I see here is that the distribution per unit growth actually accelerated. It announced a distribution per unit of 2.503 cents in the first quarter of 2025, which represents a 14.2% growth compared to first quarter of 2024. So this is driven by one of the acquisitions that it completed late last year, and I'll share more about the acquisition in subsequent slides. So I earlier mentioned that the increase in distribution per unit is driven by the acquisition of 2 data centers in the Singapore market. So this would be KDC SGP7 as well as KDC SGP8. So both of these are AI-ready data centers in the Singapore market. They are 100% contracted by global hyperscalers. If you're not familiar with the term hyperscalers, there'll be names that you might have heard of if you look at the US market. So names like AWS, which is owned by Amazon, which is one of the largest operators of the cloud service, and would actually require the data centers to be able to provide this cloud service. Okay, so then the other provider of the cloud service would include names like Microsoft, and this would be some of the global hyperscalers that we might be familiar with. So why is this transaction important? Because this is a very big acquisition, in that we see that the total acquisition cost for these two data centers, KDC HDP7 and 8, would actually amount to close to 1.4 billion Singapore dollars. Okay, so in the context of the Singapore market, and especially given the size of Keppel DC REIT, this is actually a very large acquisition, which is why when it was completed, and if it is accretive to the distribution per unit, then this is actually something that can be fairly sizable. So in terms of the rationale for the acquisition, at that point when Keppel DC REIT announced the acquisition, there were a few key reasons that they provided to be able to justify this big acquisition. So first and foremost, with the acquisition, they are able to increase their exposure to AI-ready hyperscale data centers in the Singapore market, which is Asia's top data center hub. What the REIT manager expects is that there is an immediate accretion to the distribution per unit, and we've already seen that in the first quarter numbers, where the distribution per unit of Keppel DC REIT grew at a very strong pace. The REIT manager also believes that there is room for further rental uplift, as well as capacity expansion. So with that, it actually provides a platform for Keppel DC REIT to be able to drive long-term growth. So this is the expected accretion to the distribution per unit that was shared by the REIT manager at the point of the acquisition. So what they actually mentioned is that assuming the land lease title of 15.5 years, the expected accretion to the distribution per unit is expected to be at 11.1%. If they are able to exercise a call option and extend the land lease title to 25.5 years, and if they are able to get some tax benefits from this, then the expected accretion is expected to be 8.1%. If they are able to extend the lease to 25.5 years, some of the other additional benefits that was expected to come through is higher visibility on the cash flow, given the longer land lease title that they would then have. And then this can potentially provide greater position to drive higher rental uplift from existing or new contracts. Okay, so why is the REIT manager confident that they can get higher rents for this asset? So what they see is that for the current rents of KDC HDP7 and HDP8, they actually estimated to be at least 15% to 20% below comparable rents in the market. Okay, so when some of these rents actually get renewed, they are hence confident that they can get higher rents from these leases. So at the same time, this rental uplift is also supported by what they see as positive fundamentals in the Singapore data center market. What I also see for Keppel DC REIT is that the portfolio occupancy remains fairly healthy as of the first quarter of 2025. So the occupancy rate is at 96.5%. And at the same time, they managed to see a positive rental reversions of 7% in the first quarter of 2025. So those are fairly healthy statistics, whether is it in terms of the occupancy rate or whether is it in terms of the rental reversions. So you might be wondering who are some of the key tenants of Keppel DC REIT. So we can actually look at this breakdown that is provided by the REIT manager. In terms of the breakdown, about 60% of their tenants would be customized in the internet enterprise space. And if you were to look at the further breakdown, most of these companies would be Fortune Global 500 companies, and they would be hyperscalers, like what I mentioned earlier, some of these cloud providers that would actually require this data center space to be able to provide their cloud service. So the largest customer would be a Fortune Global 500 company. This would represent about 39% of Keppel DC REIT's rental income. And in terms of the second and third largest customer, they would likewise also be Fortune 500 companies, and they will be hyperscalers that would require these data center assets to be able to run their operations. So I mentioned earlier that the fundamentals of data centers in the Singapore market continues to be fairly strong. What we see here is that while there is new supply that's coming into the market over the next few years, they have actually been mostly contracted, such as the utilization rate is close to 100%. Okay, so effectively that represents a strong fundamentals for data center assets in the Singapore market because of the fact that some of these data center assets are already pre-contracted, and that gives the data center owners and operators confidence in terms of the rental prospects of these data center assets. Okay, so one question that I commonly get is what is driving this demand for data center? Okay, so I took a look at what is driving the data center demand in North America. So if I look at the 2023 breakdown, what are the key components of the demand actually coming from? We have got cloud hyperscale, representing about 6 gigawatts of the 21 gigawatts of the data center demand in North America. Okay, so these are effectively companies that I mentioned earlier, your cloud hyperscalers like AWS, Microsoft, that would be having this data center demand. Next, we have got some of the enterprises, and that will represent about 12 gigawatts of the 21 gigawatts of data center demand in North America. So this would be companies that are big enough and would effectively be using this data center space directly. Okay, a lot of people are talking about AI and the need for more data center assets because a lot of the AI applications would then require this data center assets to be able to run their operations. In 2023, this AI hyperscale demand is still relatively limited and will be smaller than the cloud hyperscale as well as the enterprise hyperscale. But if I were to look at the demand growth over the next few years, then effectively that may potentially help to drive future demand of data centers in North America as well. So if I were to look ahead to 2030, the data center demand in North America then is expected to be 56 gigawatts. And what is expected to be driving this increase in demand is still coming through from these three components, where your cloud hyperscale will continue to grow, your enterprise will continue to grow, and your AI hyperscale will also continue to grow. And that will effectively lead to a 15% compounded annual growth rate for data center demand in North America. So I believe this is likewise what is driving the data center demand in Singapore because of the increase in demand that is coming through from the cloud hyperscales, the enterprise businesses, as well as the AI hyperscales. Okay, so when I shared about CapitaLand Ascendas REIT earlier, I noticed some of you left comments in the YouTube video. So thanks so much for that, because that allows us to understand what are some of the questions you have in mind and for us to share more about this in future videos. Okay, so if you have any questions about Keppel DC REIT, about the REIT sector after watching today's video, do likewise leave a comment in the YouTube video so that we can discuss some of these questions that you might have in future videos. Okay, so the question is, how sustainable is Singapore data center? Because we see high costs in terms of rents, overheads, as well as electricity cost. Would some of these companies, which are mobile in nature, move to lower cost countries in the region? So what this investor actually believes is that there might not be a lot of moat in data centers in the Singapore market, and has asked me to share further. Okay, so that's something that I wanted to discuss also in today's discussion about Keppel DC REIT. And I believe there's not just one investor who has this question, because I also see another comment where this investor has shared, this is what I had in mind too. Many companies are rushing into this sector. Is it really sustainable and profitable? So I guess the key question is, why do some of these companies continue to want to set up data centers in the Singapore market, given that the rent in terms of the land cost, is probably not the cheapest. At the same time, we know that Singapore is very scarce in terms of energy. So in this case, some of this electricity costs would be fairly sizable as well. So there's a very interesting observation. And I think I do see some of this affecting the data center industry over the last few years. So at one point, actually, we see that there were no new data center applications that were allowed and actually approved by the government because of the very high energy consumption that may actually be coming through from this data center demand. So this was something that was definitely being considered as to whether the continued construction of the data centers in the Singapore market can actually be sustained. Okay, so I think that is why we see that there is a greater focus on energy security to be able to have more power plants being built, to be able to diversify Singapore's energy sources so that we can have diversified energy sources, not just for data centers, but also for our consumers and also for other industrial users. Okay, so that's definitely something that is being looked at so that we are not beholden to the different energy sources that we have now and are able to continue to diversify such that we will be able to have consumers having secure energy sources. And at the same time, if you want to develop certain industries, such as data centers, we don't have to be constrained by the limited energy resources in Singapore. So then that comes to the next question as to why, even if there is sufficient electricity, why do some of these companies want to be setting up data centers in the Singapore market? I think that goes to the core of why it is important to have security in some of these data center assets, why these data center assets actually need to be in a location where there is very limited risk of disturbance. Because if you go back to what I shared earlier about some of these key customers, which are your major hyperscalers like AWS, Microsoft, they'll want the data center asset to be very reliable because if some of these data center assets are down, what this means is that there are potentially major implications on their ability to run different software services, provide the cloud usage in a very reliable way. Okay, so you don't want to hear any news about disruption to your access to some of your favorite websites, to your favorite applications. And hence, it is very important for some of these key customers, which are running the cloud services, to be able to maintain a very high degree of reliability on their data center assets. So that is where being able to be in a location where the risk of disruption is very limited is very important. Because you don't want the data center asset to be, say, at a place where you don't have 100% certainty on the provision of the electricity. So for example, if there is a blackout, then that is potentially going to damage your reliability of the data center. If it is in a geography that is very prone to, say, natural disaster, then that is a risk as well, because in the unexpected scenario where you actually have some disruption due to a natural disaster, then that is going to affect your reliability of the data center asset as well. So the good thing being in Singapore, if you are an investor that is based in Singapore and watching my video today, what you probably know is that for Singapore, we are very fortunate that there are effectively no natural disasters. We have a very high degree of certainty towards the provision of power as well. So I don't think any one of us here has encountered a blackout in our more recent history. So effectively, that provides the clients of these data center assets with more certainty around the reliability of these data center assets as well. So even though some of the costs may potentially be higher, especially in terms of the land cost compared to other markets, such as maybe in JB, this can be something that the owner of the data center asset would be able to convince the customers on, really because of the reliability of having the data center in the Singapore market. Okay, so based on the REIT checklist that I have, the other thing that I keep a very close lookout for would be the gearing level of the REIT, because we don't want the REIT to be overly leveraged. So what is another positive for Keppel DC REIT is that the aggregate leverage is at a fairly low level after the placement that they did with the acquisition of the 2 data center assets in Singapore. The leverage has been brought down to 30.2%. And this is a 1.3% decline from 31st December 2024. So that actually gives the REIT manager more headroom if they want to pursue further acquisitions. Okay, in terms of the interest coverage ratio, that is at 5.8 times, which is once again very comfortable compared to what is actually the average for the REIT sector in the Singapore market. Next, I will take a look at the valuation of Keppel DC REIT. So that is another important factor to consider for REIT investors because we want the price to book ratio of the REITs that we're investing in to be reasonable, and we also want the REIT to offer a decent dividend yield. So what I see here in terms of the price to book ratio of Keppel DC REIT is at 1.5 times, which is above the sector average. However, this is actually close to the historical average of Keppel DC REIT because of the growth in its asset under management over the years. It seems that investors are willing to pay a higher price to book valuation for Keppel DC REIT. So once again, you might be wondering where to find the latest valuation charts of the REITs. And now I'm going to show you where I get this price to book ratio as well as dividend yield charts from. So I'll come to the Beansprout website where we provide insights on Singapore stocks, REITs, bonds, and ETFs. And with that, we also have some of these valuation charts for the Singapore REITs. So what I'm going to do here is to look up the latest valuation charts of Keppel DC REIT. So I shared the price chart of Keppel DC REIT earlier at $2.24 as of the latest closing price. And I'm going to find the valuation charts of Keppel DC REIT. So what I see here is that it is now at 1.47 times price to book. And like I mentioned earlier, this is above the sector average of about 1 times. So another key metric that I'll look at would be the dividend yield of Keppel DC REIT. And here I'll be able to find the dividend yield by going to the dividend tab. On this page, you'll be able to find all the dividend data of Keppel DC REIT, including the historical payout ratio. And based on what I see here, effectively, Keppel DC REIT announced a distribution per unit of about 2.5 cents in the first quarter of the year. If I annualize that to the full year, it will represent a potential dividend payout of about 10 cents. And if I look at the current share price, about $2.24, that will represent a dividend yield of about 4.5%. Okay, so if I then compare that to the historical dividend yield and the sector average, what I see here is that the dividend yield is below the historical average as well as the sector average. Next, what many investors might also be interested in would be the share price target of Keppel DC REIT. So what I see here is that based on the average target price of analysts who are covering Keppel DC REIT, the consensus share price target is at about $2.34, and that is slightly above Keppel DC REIT's current share price. Okay, so from this, it would effectively represent that on average, the analysts who are covering Keppel DC REIT expect that there may still be some potential upside to Keppel DC REIT's share price. But like I would always share, it is important to do your own analysis and not just base your investment decision on what the consensus share price target is. And hopefully from today's sharing, you have a better understanding of Keppel DC REIT's fundamentals. So having gone through the fundamentals of Keppel DC REIT, I wanted to go back to what I started the video with, which is the inclusion of Keppel DC REIT into the Straits Times Index. So a question that you might have is, then is it worthwhile investing in the Straits Times Index if I want diversified exposure to the Singapore market rather than an individual stock or REIT like Keppel DC REIT? So I'll put up the chart of the STI. So what I see here is that the STI has done very well over the past 12 months. In fact, at this level, it is actually close to its all-time high of above 4,000 points that was actually reached earlier this year. However, if I were to look at the longer history of the STI, what I see is that between 2015 and 2023, effectively over this period, the price performance of the STI has effectively been within a certain range. So what this means is that for investors who are looking at the STI and had invested in it between 2015 and 2023, may not have seen significant capital appreciation coming through from the STI. So this is what I see in terms of the total return of STI, whether is it over the past 12 months, over the past 3 years, or over the past 5 years. So given the very strong performance of the STI over the past 12 months, what I see here is that the total return over the past 12 months of the STI is at 23%. Over the past 3 years is at about 40%. And over the past 5 years, the cumulative return is at 95%. If I look at it from a per annum basis, then over the past 3 years is at about 12%. Over the past 5 years is at about 14% on an annual basis. So past performance is not a reflection of future performance, but from here we can get a rough idea around what has been the historical performance of the STI. So to understand the performance of the STI, we need to understand what actually makes up the Straits Times Index. Earlier, we looked at the top 10 constituents of the STI, and here I break it down by sector. And what we see here is that the banks represent 52% of the STI. Okay, so this would be DBS, UOB, and OCBC. And as I shared earlier, DBS would be the most significant contributor, and that effectively is one of the key reasons why the STI has done well over the past 12 months. I mentioned earlier that Keppel DC REIT will be included in the STI, and what we already see is that the real estate sector is already a very big part of the STI. Okay, so real estate sector with 11 constituents would be the next largest sector of the STI at about 15% weightage. So this would be representing the likes of CICT, Mapletree Logistics Trust, Mapletree Industrial Trust, these large REITs that many of us are familiar with. And with the inclusion of Keppel DC REIT, we will see the number of real estate stocks in the STI going up even further. So what this means is that if you are looking at the STI, even though it is a diversified exposure towards the Singapore market with 30 constituents, the performance of the Singapore banks is actually very important in driving the continued outperformance of the STI versus a global benchmark, because banks represent 50% of the STI, and if the likes of DBS, UOB, and OCBC don't do well, then it is very unlikely that the STI is going to have a very strong performance. The other reason why investors might consider the STI is because of the dividend yield. And what I've done here is to compare the average dividend yield of the STI versus other major indices to understand how that actually stacks up. So what I can see from this comparison is that the average dividend yield of the STI is actually higher than some of the other major indices. For example, we see that for the Hang Seng Index, the average dividend yield over the last 10 years is 3.52%, which is below the average dividend yield for the STI at 3.94%. So because we've got a lot of companies that are paying a fairly high dividend yield in the STI, so for example, the Singapore banks, Singtel, as well as some of the REITs, that has actually led to a fairly high level of dividend yield for the STI compared to other major indices. If I compare that further to the European index, if I compare that further to the S&P index, then what I see here is that the average dividend yield for the STI would be above these other regional indices. So if you want to gain exposure towards the Straits Times Index, then we need to be able to find funds that are effectively providing exposure towards the Straits Times Index. What is important to note here is that you can't buy the index directly because the index is just meant to represent a benchmark, and it is effectively a representation of the 30 constituents of the STI. But if I want to gain exposure towards the STI, then I can potentially do it either through an exchange traded fund, which would then be tracking the Straits Times Index, or a mutual fund that would effectively be actively managed but would potentially seek to deliver higher returns compared to the benchmark. Okay, so if I'm looking at exchange traded funds, these are effectively then traded on the SGX, and you can buy and sell them just like you would buy or sell a stock using your usual brokerage account. There are two ETFs that offer exposure towards the STI. The first is the SPDR Straits Times Index ETF, or stock code ES3. And the next one will be Nikko AM Singapore STI ETF with the stock code G3B. So in terms of both of these ETF, they would both aim to track the Straits Times Index. And we see here in terms of the expense ratio, both of them are quite similar, with the SPDR Straits Times Index ETF having an expense ratio of 0.28%, and the Nikko AM Singapore STI ETF with an expense ratio of 0.25%. In terms of the asset under management, the SPDR Straits Times Index ETF would have a larger asset under management of about 1.7 billion as of the first quarter of 2025, while the Nikko AM Singapore STI ETF will also be quite decently sized at about 903 million. So for some investors who are thinking of gaining exposure to the REITs, but having heard from my sharing that a big part of the constituents of the STI is actually coming through from the banks, might actually then think about wanting to gain direct exposure to the REITs through a REIT ETF instead. Okay, so in this case, you would be gaining higher exposure towards the REITs rather than diluting it through other holdings, such as through the banks or through other large cap stocks in the Singapore market like SIA or Singtel. So if I were to look at this list of REIT ETFs, we have the Nikko AM Straits Trading Asia ex Japan REIT ETF, which has the largest asset under management. But it is worth noting that for this REIT ETF, it would effectively have holdings of REITs that are not listed in the Singapore market. For investors who are looking at ETFs, which just have REITs that are listed in Singapore, then the ones to consider would be the 𝗲𝗵𝗲𝗀𝗃𝗃 S-REIT ETF, as well as the CSOP IH S-REIT Leaders ETF. Lastly, I wanted to go back to Keppel DC REIT and do a roundup of what I've shared today. So first and foremost, in terms of some of the positives of Keppel DC REIT, we see that the REIT has been able to deliver DPU growth in 2024, even though the REIT sector generally faced headwinds. So this was supported by positive fundamentals that we see for the data center segment. We discussed some of what is driving the higher demand for data center assets, And we see that for Keppel DC REIT, they've been able to maintain a healthy occupancy rate as well as enjoy positive rental reversions. Next, we also saw that Keppel DC REIT has been able to grow its portfolio value to about 5 billion from 1 billion back during its IPO in 2014. These acquisitions have helped to lift the distributions, like what we saw for the 2 data center assets that acquired in 2024. And with that, the distribution per unit in first quarter actually grew very strongly. Next, for REITs, we also want them to have a low gearing ratio. And what we see for Keppel DC REIT is that it has a low gearing ratio, and that provides more debt headroom if it wants to be making further acquisitions. We started the discussion by talking about Keppel DC REIT's inclusion into the Straits Times Index. And with the inclusion to the Straits Times Index, we may see some funds that are benchmarked to the Straits Times Index actually buying into Keppel DC REIT. There are other considerations that we should bear in mind for the REIT sector, and one of it is definitely the valuation of the REIT. So I shared earlier that for Keppel DC REIT, from the latest charts that I see, the dividend yield is below the sector average, and the price to book valuation is above the sector average. Going back to Keppel DC REIT's inclusion in the STI, you might be wondering when this will take effect. So from this announcement, what we see is that the changes are expected to take effect at the start of business on 23rd of June 2025. So if you would like a reminder of this important date, do sign up for the Beansprout newsletter, and you can find the link in the description in this YouTube video, where we'll share important dates to keep a lookout for investors in Singapore stocks, REITs, bonds, as well as ETFs. Also, once again, do subscribe to our YouTube channel, where we will continue to keep you updated about some of the latest developments in Singapore REITs as well as other stocks. Okay, so if there are other REITs that you want me to be sharing more about, once again, do leave it in the comments below, and I'll be happy to discuss some of the REITs that you are interested in or have questions about. If you find this video helpful, do like the video, share the video with your friends, and subscribe to our YouTube channel to be able to get our latest updates. If you'd like to stay updated on Singapore REITs, stocks, bonds, and ETFs, do visit our website and follow us on our various social media channels, where we continue to provide you with updates around some of these names that you are interested in.